Here, Alex. Hey, Kevin Green's back. The man. Hey, how about that little profit take at 54.50? I guess that was a pretty good place to take a little scalp.
Yeah, it seems like that's where what they really wanted to do. And actually, I mean, the close is still pretty decent. It's sitting at 54.46. I mean, so only about 4 points off. So that was actually a pretty decent close. Hopefully we have some follow through today. And if we have some pretty decent earnings, maybe that'll be a catalyst for us to try to kind of break out of this slump that we had earlier in the session.
Okay. What do you think, Alex? Is there hope here for Apple? If you want to chat intraday real quick, you can. We've got time.
Well, I was just going to say, it looks like Amazon's hit the wire, as well as it looks like Intel's moving as well. Intel looks like it's down about $2, which is going to be, let's call it 7%.
Yeah.
Amazon, I got some numbers, though, for you.
Okay,
EPS, $1.26 is way better than the 104 expected. AWS, though, was strong as well. $26.28 billion beats the $25.98 billion. Net sales or revenue does miss, though, overall. Lending some credence into what Nate Peterson was just talking about with the weaker consumer, knowing that those are sort of how the two revenue drivers break down. Just under 148, they were expecting 148.8. North America, 90 billion though does beat, basically are in line with about the same for estimate. It looks like that isn't where the weakness is. So I'll have to see where the weakness actually ends up showing, but the initial reaction here, which I think is most important, is down about $6. That would be way inside the expected move, but it is still lower. And you can see the NASDAQ futures lower in response, as well as the S&Ps.
Nothing on the top line looks to be an issue. I mean, it looks like a really clean report when you've got sales still kicking at 10% net, and then all the parts of the business still are positive. AWS 19% higher. I mean, that beat the estimate a little bit. And so did operating incomes, which were up a lot. Margins were pretty good.
It's a Q3 guidance disappointment, it seems.
Okay.
154 to 158.5 is what they provided. The estimate
was the operating
158.5.
Is that even right? I'm reading on right now.
Operating income, a big miss too.
11.5 billion to 15 billion. The street was looking for 15.7. Is that a massive miss, KG?
Say that one more time, Oliver.
11.5 to 15 billion. They see third quarter operating income. Street, according to Bloomberg, is looking for 15.6. I mean, hopefully that's a typo or that's a major miss.
Yeah, that's a major miss. Maybe they have a one-time situation that's actually happening there. We'll probably get more details on that. Okay. But it does appear that, once again, as Alex was talking about, it is a guidance issue. And once again, you're going to have these conservative guides if we have a little bit of a murky macroeconomic outlook here. And they did talk about AWS and still trying to reaccelerate that growth that they've seen in the past here. And maybe that's also kind of causing the stock reaction to the downside. But I'm not sure why that guide missed by so much. So maybe they have maybe something in there that'll give us some more insights on that.
Yeah, we're definitely going to want to get some, look at the call on that maybe. So, look, I mean, bottom line, though, is that if other than that, I mean, well, I guess it's not the bottom line. It really matters whether or not that is, something that can be excused. The market's not waiting around to find out because again, there were beats and there were growth on the trailing. And I thought that this was kind of the best position to chart out of the Mag 7, to be honest. It seems like it's been the most consistent. 174 is not too bad, Alex. I mean, that's like Tuesday's low.
Yeah, we'll see where it settles in. If there's going to be buyers that want to step ahead of the jobs data as well. So that might be a delayed onset kind of buyback, similar to what you saw in Microsoft. But it does look like, though, although the operating income, who knows, there could be those one-time things. You can't really say there's one-time things affecting sales, and that Q3 sales guide is disappointing still as well. The midpoint's basically equal to the top end of the range they provided. So they are suggesting that they see a little bit weaker than the street saw. So maybe some move lower is to be expected here. We got to bear in mind this stock was already about 8% off its highs. So at the same time, this muted reaction inside the expected move also, to me, makes sense.
Okay. All right. That's a good point. So the market was looking for something bigger?
The market was looking for about $12 this morning when we were on Fast Market. I actually didn't look right before, but I'll pull it up right now. It looks like, about $12.35, so it remained consistent. That would have targeted, down in the low 170s, which we did tag. So it kind of got down to that level. Buyers stepped in. but already stabilizing here. Look, it's way too early to say anything. Apple could have an impact on this. If Apple's negative, you're going to then have Intel negative, Amazon negative, and potentially an Apple negative. That'll make, I think, all of them weaker.
What do you think about Intel, KG? Are they so far behind it's not even worth talking about, or is it at this point important that they just cut through a range they had held for like 2.5 months?
Well, I would think for Intel in the near term, yes, they're going to have some headwinds. But if you're looking at the longer term vision, especially when they're going to be opening up some of these high tech foundries in 2030, that they continue to push that back. Once that actually does become available, that's when they're probably going to get a pretty significant premium in the market.
Oh, wow.
Because it'll allow.
Hey, KG, Intel suspended their dividend.
Yeah. Well, that's a problem.
That's a huge problem. That's like nightmare fuel.
Yeah, you do not want to do that, especially when you're cutting we had the announcement or the leak the other day too around them cutting a significant amount of staff here. So that along with the dividend does kind of signify the fact that they have a lot of pressure going for their company right now. And that's not a really good sign. And this is actually used to be a pretty decent dividend aristocrat too. Yeah. So taking that dividend away for those investors that have been probably investing in this name for the last 15, 20 years is something that could actually cause a significant rotation out of the stock.
Not supposed to happen.
Some more details related to that job or headcount reduction. They're planning a 15% headcount reduction, $10 billion cost reduction plan. This is full-blown defense from an Intel. This is not an offensive company at the moment. So when they're trying to be positioned by analysts as a challenger to the AMDs, the NVIDIAs,
sounds like they
this
just
is a
they're
company
not.
that is saying, yeah, we're not only not, we need to figure out how to make this work now because we're in dire straits. And so look, I'm not trying to make it sound like Chicken Little, sky is falling, but the reaction is more than warranted because this is a very different message than those who've been bullish on Intel wanted to hear or expected.
Boy, I've never felt so old in my life. Intel
also makes Amazon look a lot better, and that's why Amazon's up to 181 now.
Yeah, I feel like really an old man at this point because Intel was like just the tech god for all of us growing up, basically, and now they're cutting their dividend. That's a very seminal moment, really, and we can say, yeah, a lot of this is competitive forced. Of course, NVIDIA is creating trillions. So, I mean, look, that's how it is. The corporate world is one of gnashing teeth. So, at the same time, though, KG, the layoffs too, it starts to bleed into our macro discussion a little bit.
Yeah, definitely. I mean, especially after the prints that we saw here today, it does appear that we have a little bit of pressure. Now, Intel is also in a situation where the PC side of their business, whether you're talking about enterprise or even if you're talking about consumer, just hasn't bottomed out yet. I mean, we had some positive commentary coming out of Qualcomm yesterday until they actually fell off a cliff, and it just doesn't seem like they've been able to innovate. And so I think if they're able to get the foundry business up and running, and if they can accelerate that timeline as much as possible, then investors are going to probably pick up this name. But if they, if you're looking at a cut of the dividend, I'm speculating here. If you're cutting the dividend, you're cutting staff. Are you going to be cutting that foundry project? And if that's going to be the case, then that's when you know that there's a significant problem. I'm sure there's going to be an analyst that actually is going to probably ask about that on the conference call here today, because that's really the only bright spot that you have for this business right now as the consumer continues to slow down here.
That would be full-on white flag. If they did that.
There's not a lot of positive here. Some commentary from the CFO said the cuts mean company can now fund the business. They talk about second half looking a lot weaker, inventories building up. You look at the AI and data center revenue, doesn't even beat the expectation, comes in line, but at $3 billion. You look at what they're guiding for margin. This is alarming. 38% for the third quarter gross margin. The expectation was 45.5%.
Oh my goodness.
The margins for the quarter reported 38.7%. They were expected near 44%. This is This is what happens when the street is offsides on something, and it just happens to be a massive company. This is way worse than expected, and it makes sense why the stock has been bludgeoned and is getting bludgeoned again in the after hours.
The last 2 quarters, keep in mind, we had top line growth for Intel. It looked like maybe they were going to be able to find their way through as possibly like a lower quality, cheaper alternative to some of this high-powered stuff. So that was apparently a fluke because, I mean, the outlook here is that's all going away, KG.
Yeah, I'm still surprised by the dividend. I mean, that's the only thing that really they had a leg up on with the price being as low as it is, right? So, at this point, we'll have to get more information on the conference call. When you're starting to talk about inventory builds, as Alex just kind of mentioned here, that was a scenario that we saw within the industry a year ago, a year and a half ago. And if they're still just starting to see that taking place now, I think that that's a really bad sign. Maybe not for the broader macro economy, maybe not when it comes to broader tech, but at least for that company and specifically, that's kind of the downturn that you have. And I'm not sure what bright spots you have as an investor to try to get in this name right now. There's no real bright spots. I mean, if you had a decent 4%, 5% dividend yield, you could make a case, but that's gone now.
Okay, well said. Yeah, that is historic to see Intel cut the dividend and really fall to the bottom of the list here as a tech leader. Amazing stuff. Speaking of the bottom of the list of tech leaders, should we talk some Snap? Once again, doing kind of Snap things. Look, I feel like a lot of people are like, why are you still talking about Snap? But I actually think it's pretty interesting because they've got a big content division they've been trying to build out, and it's kind of lost its sea as a company overall compared to the other big advertisers. And there might be a little macro bleed through too, because the marketing and advertising budgets just don't have room for Snap at this point, I don't think, Alex.
It looks okay until you get to their guide for the adjusted EBITDA between 70 and 100 million, the estimate 110 and a half. You don't look any further than that. Everything else basically in line or slightly better, but that's such a massive miss on such an important metric for a company that's lost its growth. This is explaining why you see the stock now trading in single digits.
Yeah, this is one where I wonder, will somebody pick it up, or will it try and find a buyer somewhere, maybe private, and try and make it more streamlined and super AI based? I mean, I feel like there's a lot of stuff here. You could just plug in a smart AI and give people maybe a more direct, targeted experience. Because again, I've said before, the content's actually pretty fun to watch. I watch a lot of shows on there because it's just bam, bam, bam. You go right through. KG, is there any hope for this stock?
I'm not sure. I mean, they continue to have really good subscriber growth in user metrics, but they're not able to monetize, Oliver. And so, I kind of go back to talking about MySpace. You're kind of talking about what we've seen in the past here. MySpace was kind of the same, similar situation where it was very popular until you started bringing on too many ads. And is that really discouraging a lot of these users on the platform to really engage with the platform outside of maybe some chat features and maybe watching a video or two? And this has been kind of a theme for them over the last couple of quarters. Actually probably the last year and a half, 2 years, and it hasn't really turned around. I mean, at the end of the day, every user that they're adding to the platform at this point, they're kind of making less and less money. And we're not really seeing a bottom line impact when it comes to that. So we have to hear what the vision is going to be. But unfortunately, at some point when you see the stock trading at $13 or $10 now, and you kind of look at that chart, you have to say, is it really worth it? When you can look at a Meta that's printing cash hand over fist and providing you probably a better stock appreciation yield as well as a dividend yield.
True.
Last thing on that real quick too, if budgets are going to get tighter, you're cutting staff, you're not going to blow up your marketing budget, you're going to be more selective with your dollars. Meta has tangible information on their AI and ability to reach the end consumer with their ads. Even if it's more expensive, you got to go to the place that actually gets you business. If Snap is losing eyeballs or not growing them and your ads aren't that successful there, you're going to spend slightly more to go straight to Facebook or Instagram.
I really feel like their ads are not successful, and I feel like they're still like experimenting on the best way to do ads because they've changed the way the ads appear to you, where you could skip them before, now some you can't. Like, it's still such a experimental effort compared to everything else.
And I've said all along, when you look at that space, it's been one where the ads are intrusive.
Yeah.
Where on Meta, because
of
how they rolled out the changes at Instagram over the years, they've just become part of the experience. You're not disrupted by it. Next thing you know, you're buying something on Instagram Shop. Same thing with TikTok. Same thing with Pinterest.
Yeah, I feel like we'll be validated at some point. Somebody's going to buy them for their content delivery of TV programming. It's like, I'm telling you, it's a great way to consume. All right. Well, I felt old with Intel. I guess maybe because I watch TV on Snap, but I'm not that old yet. Well, let's talk DoorDash here. I'm definitely familiar with this one. Shares up to 123 bucks, but they missed pretty big on the bottom line. But here's the thing. DoorDash to me is like, it's almost like the Carvana of like, it's like in a way, we always think that like these delivery companies are just going to go bye-bye and then they stick around. And it's actually been an okay year for Dash. So it's going to jump a little bit in the aftermarket. Does anything stand out to you, KG? Get us started.
Yeah, if you're looking at the adjusted EBITDA margin outlook for Q3, they're looking at 470 million to 540 million. Estimate was for 453 million. That's remarkable.
Wow.
You're talking about pretty much an 80 million to a $100 million beat. So yeah, you can have some weakness in other areas, but at the end of the day, you want profitability, and it seems like that is what they're aiming for here. That's the number one thing that I see. You know, the CFO does talk about U.S. restaurant demand has slowed down, so it hasn't really seen a decline when it comes to consumer engagement. But another macroeconomic factor that we've been kind of seeing in the retail sales data as well. So this is another company that can provide us additional insight into the consumer and its behavior. But they have been able to expand their network. And so if they're able to expand their network and overcome maybe some of the headwinds when it comes to consumer demand, that could be a positive for them. And it seems like that's working right now.
Yeah, this looks like it really is. But then there's also memes going around about people complaining about inflation. And they're like, is it inflation's fault, or did you order a private taxi for your burrito?
It's a good point. Kevin nails it in terms of the metrics that's sticking out. That's the one highlighted. That's the one that is really strong, which is the guide for EBITDA. But I think if you gave the leaders at Uber some truth serum, you asked them, who do you actually worry about in your industry? They're all going to say DoorDash. They're not worried.
Well said, Alex.
This is the real competitor to Uber.
Yeah, all right, very well said. All right, boy, historic day here for Intel. Appreciate it. Thanks very much, guys.